Now we're going to kick off, as we always do, this segment 2, looking at a general overview or summary of what has happened so far. And this is, you can see not only just the day-to-day, the week-to-week numbers, but also the 4-week rolling average. So the current week had demand at 13.686 million. Last week was at 15.883 million. So you can see how there was that huge drop off, and the down move is really the weakest it has been going back to about May, end of May, beginning of June. And it's not crazy to see that, given the fact that time of the year, there's always a big drop off when you're looking at the difference between the holidays in terms of how long are people driving, where are they driving, are they staying, are they driving around? We had Christmas, Christmas Eve on a Friday, Christmas Day on a Saturday, which then meant New Year's Eve on a Friday, New Year's Day on a Saturday. So some people took the week, and you just had a big drop off. And you also kind of front loaded some of that demand to making sure that because remember, this is looking at it coming from the racks and going onto a truck and heading to the final destination, which is obviously the pump. So you're seeing how this is now going to, where are we going to go from here? And you can see where we were in 2019, sitting at about 14.5 million. 2020 was right around there. When we look at the 4-week rolling average, we closed out pretty close to where we were for 2018, 2019, and a lot of that was on the back of distillate and diesel in general, which is something that's going to continue to be a bright spot as we go into the first month of the year. And January is normally slow, as you can see from the seasonal data. January is normally a problem when you're thinking about how often do people go out, what are people doing. There's a little of a sluggishness coming from post holiday, where you just want to take it easy for a bit. And then things start to pick back up as we go into the Martin Luther King long weekend. We don't see that changing all that much. If anything, it should be accelerated a touch, just because of Omicron and people just not moving around at all that much, and trying to limit. Because I know my kids had to be on Zoom the first 3 days of this month, or this week, I should say. They go back to school full-time next week. Tomorrow. Some people go back full-time next week. And the idea was, if they have COVID, letting it kind of the symptoms to appear, try to minimize some of the spread that would happen if we just ran back post people meeting up and seeing family and friends for the New Year's Eve, New Year's Day celebration. Now, when we look at distillate had a build of 4.42 million barrels. Pad 1 was the only one with a draw of about 90,000. That brings us 34.8 million below the 5-year average. So we're still closing in a very bullish position on the diesel disty side. There were builds across the board, when you look at where are most of these draws accumulating, it is in Pad 1. Pad 1 is 26 million below the 5-year average, which is why we do expect to see, again, big imports is a bit of a exaggeration, because the Pad 1 is importing 174,000 barrels a day. That's not a huge number, but it's a real number because it is well above the 5-year average, and we do expect that to continue given where the spreads are, given where things are getting a bit cooler coming into the first 2 weeks of January, which will increase the overall demand, especially in Pad 1, keeping the 5-year fairly tight and imports robust. So when we look at demand in general, one of the things that we were expecting was to see a huge spike up, a huge spike down, and then a bit more normal along the 5-year average. And that was really exactly what happened, where we had this big spike up, big spike down, and you can kind of see how the spikes were shifted a little bit earlier because there was a bit more of momentum to get product into market prior to the very extended holiday that people took. And then things fell back into what would be deemed as, fairly normal. And then you'll see that continue into the first week of January. And then we'll start to see a big acceleration in demand as things start to catch back up in the second or third week of January, depending on really timing as to where does it sit. One of the things that we've been saying was we were going to see a nice uptick in trucking demand. Trucking was going to come down. People go home for the holidays, and then they have to get right back on the road trying to replenish what was essentially purchased for the holidays. So we do expect this to remain between that 150, 175, and we expect that to be fairly strong. Diesel prices have started to flatline. Gasoline prices starting to creep back up, and that's something that's going to weigh on some of that demand. Also, some of the inflation, as we've been talking about, the pace of inflation really slowing and really giving way into more of that stagflation. So then when we look at the rail traffic this week, or I should say, the way how they closed out the year, you can see that grains had a bit of a drop while everything still stayed fairly strong, especially coal. We will see those grains again remain fairly strong, as you can see on the year-to-date level. Motor vehicles starting to catch back up. Chips remains a problem, but we're starting to see some semblance of normalcy coming back into. They're still very short, still a lot of wood to chop, but the motor vehicle side is getting a bit better. Petroleum products still remains under pressure, and versus 2020 as well. We were expecting to see a bit more movement from Pad 3 to Pad 1 that didn't pan out the same way as we were expecting, as intermodal came back down, and that's something that we do expect intermodal to remain strong, and realistically start to take over and be fairly robust as we go through the first three months of the year. When we look offshore and look at what's sitting in the water, there's still a lot of boats out there. We're still 25% over last year, 14% over the previous week, and that continues. And we do expect to see more boats added in that third week of January. As some of them have been told, don't wait near the coast. You have to slow steam. You have to be further offshore, which is why some of that in the third week is a bit lower. But then as we get closer, they get pulled on shore. They fall in line to make sure that they have essentially their spot in the queue, and then that will increase that. So we do see a lot of these boats remaining offshore, keeping things fairly robust, moving through the U.S. The U.S. supply chain. Temperatures in general. So we talked about the East Coast when we look at what's happening in the Northeast, and then what is really happening pretty much all through the Mid-Atlantic, while the Midwest, the North, the South, and large parts of the West Coast will be above normal. So just based on who uses what where, the Northeast consumes a significant amount of heating oil, so this will be positive for the diesel side. And then the other areas consume, obviously they do also consume heating oil, but also a lot of natural gas. So this will be a bit tempered for natural gas. But because of just depending on how severe some of this cold is, as you look essentially from the Mississippi east, that will dictate of maybe even though things are a bit warmer, you'll have some heating degree days increasing just because you have such a cool down on the East Coast, increasing the amount of demand for fuel for heating, which would come under natural gas as well as heating oil. But regardless, one of the things that we do see this bullish for is the heating oil side. So now when we look at gasoline had a big build of 10.13 million. That now brings us only 2.7 million below the 5-year average, which is what we were talking about, that the comps get easier. And we expected to see the comps get much easier, and that was going to put us into a fairly strong position to kick off the new year. And we do expect to see, and typically, just based on this chart, you can see how, seasonally speaking, January, you do have these steady builds. We did get an increase of 163,000 barrels a day of imports. That's still 126,000 below the 5-year average. But just given where things sit in the U.S. on Pad 1, where Europe is, we do see some additional flow through. Imports were at a 5-week high. And we do expect to see some of that remain as we go through the next 2 to 3 weeks. And when you look at driving, so China still remains below normal. We think that that's going to continue and actually get worse as they can continue to face Omicron and the fact that it is highly contagious, and they do have that zero COVID barrier. Google Mobility is just reflecting that slowdown. You'll see that bounce, but we're just not going to see it back to where it was as you saw Apple Mobility also have that steady drop. I think the Gas Buddy data is good at putting it in perspective. You had that nice surge as we went into Christmas, and then those 2 weeks of drop off as people either stayed where they were because they were going to stay all through that week, and then when they came back, it came in spits and starts. So it was so kind of spread out really that you saw this drop. And then we do expect to see this remain fairly depressed as we go through the first 2-3 weeks of the year, just given where COVID cases are, how people are kind of avoiding excess travel. I can speak by me anecdotally that things are fairly slow. There's not as much traffic. There's definitely a certain amount of hesitancy. You're still seeing people in stores. You're still seeing people in restaurants. It's not a full stop, but you are seeing some reductions from where things were even in the middle of November. So according to Gas Buddy data, U.S. gasoline demand fell last week by 4.5% from the prior week, which is the lowest weekly demand since the week of May 16th. Again, nothing too surprising there. We thought we were going to get to about $3.27, $3.26 on gasoline. We got to $3.27.5, and now we had a little bit of a bounce to about $3.28. And just given where crude has gone, we do expect to see gasoline prices now creeping back up and moving back into the $3.30 range. Now, what we thought we were going to see a little bit of a drop closer to about $3.60, $3.58 on diesel. Instead, we're flatlining here, and now we do expect this to go back up to about $3.63, $3.64. And this diesel side is what's going to put the most pressure on the consumer because, again, this is a pure pass-through and is straight cost when you're looking at how are things dictated on what the price is going to be within stores. Blending components surge back to the highs. When we look at this, the blending components had a build of 10.76 million barrels. That now takes us 7.6 million above the 5-year average, and it takes us right to a new all-time high, which is again right where we were expecting on the blending component side. Now, when we look at demand, when you look at gasoline demand, you had that big spike, which we were saying was going to happen just based on what we've seen so far. Because when you go over the last few years, you don't really get a spike. You kind of you get a spike up, and then you don't get another spike, but instead you just go sideways because demand is still there. You're still seeing things move. Instead, because things are so lumpy in lumpy in 2021, and I think will remain at least for the first quarter in 2022. We're so lumpy, you're getting these extremes. And I know everybody likes to make a headline on, new all-time high of demand. It's like, well, you really have to streamline it because, no one, I haven't seen any headline coming out talking about how bad demand was this week because it wasn't a new record last week, and it's not terrible this week. It's just you have to look at them connected to get a true picture of kind of where things sit at this point in time. So then when we look at the demand over the last 5 years, you can see that we're right back to where we were in 2020. When 2020, but you were at a new high compared to previous the week before. So realistically, you're averaging out to right where we should be when you're considering where we were versus 2018, 2019. So then when we look at some of the driving data and the activity, you can see that groceries, things slow down. This is still picking up the weekend of New Year's. But when you look at the workplace, we do expect the workplace to recover, but not back to where it was pre-Christmas, because that's something that we don't think we'll see until about Feb. And based on what we're hearing from companies, probably mid-February, which will keep things a bit depressed on a structural basis when we're looking at weekday data. And then here, when we look at seasonality, you can see that there's typically that drop as we go into December. So we had something fairly normal, not much to talk about there. On the propane side, we had another draw of 730,000 barrels. That brings us at 13.8 million below the 5-year average, and right in line with kind of that bullish setup for against 2017 and 2018 numbers that we think is going to be the one to watch, as days of supply remain at almost on the nose at where we were for 2018, and we think that that's going to accelerate as we go into the first month of January. Now, when we look at Jet had a small build of 370,000 barrels. That's 8 million below the 5-year average. And as we've been saying, we expected to kind of have this chevron pattern sideways in demand. And that was exactly what we got. And we expect to see that stay fairly in line at that 1.4, 1.5 level as we go through the first week of Jan. And the TSA passengers, as we made the call back in March, you were going to get a seasonal increase, but you were going to see it kind of crest, if you will, over the summer, not getting quite back to where we were in 2019. As we had some international flights coming back, we closed the gap a bit, but we're still 300 to 500,000 people a day against versus what we were normal, and that has continued. And now when we look at the previous year, you can compare it to where we were not only in 2021 but also in 2020. So you can see that we're still below where we were in 2020, 2019. Obviously well above where we were in 2021, but we do expect to see this 400,000 person a day decline remain at least as we go through the first quarter of the year. Flight departures, the global summary, we had that seasonal drop. I don't think there's anything crazy here to write home about. Average number of departures per day decreased by just under 1.8%. Global departures are at roughly 71% of the December 2019 average. Departures in China led growth this week, while departures in the US, Canada, and India led declines because you did have some excess, then they came down. There was obviously issues when you're considering what happened with not only COVID, but also the massive cancellations from weather and personnel shortages, which also resulted in some of the declines. And when you look at what normally happens in January, you normally have this kind of steady reduction, and that's something that we think is going to still remain the case. Open table, obviously things are lumpy because of the holidays, but we're starting to see a bit more of this hesitancy on going out. So we do think that we're going to see 15 to 20% decline weekday, and about a 10%, 5 to 10% decline on the weekend, at least as we go through January, which is just showing a bit of that slowdown on activity. And it'll be more than what is normal because we normally have a slowdown in Jan being slow, that we just think that that's going to be exasperated this year, putting us in a fairly, again, speaking of builds across products and just putting some pressure on where that demand is ultimately going to be for Q1 of this year in the U.S. Now, as we went through the U.S. data, we're going to go into what is happening in the global market, and we're going to kick off with global crude flows and then talk about where U.S. exports sit and what is happening again on a global basis as we look at issues in Kazakhstan, Libya, and shifts in just the geopolitical landscape.